If you turn on any financial news channel today, you are going to hear an incredibly triumphant narrative. India's tax engines are firing on all cylinders, bringing in absolute record-breaking numbers. The headline across the board is loud and clear: the economic engine is booming. But if you look away from the flashing news tickers and look closely at the actual structural machinery of the corporate sector, a completely different picture begins to emerge. Factory output momentum is cooling off. Corporate optimism for next year has literally halved over the last month. This leaves us with a massive, fascinating paradox. How can corporate India be slowing down if the government is collecting more tax than ever before? Is our economy truly booming, or are we quietly entering a cooling phase? The answer isn't a simple yes or no. The truth is hidden inside the micro data of three distinct pillars: a tax illusion, a capital goods slowdown, and a massive wildcard crashing in the global commodities market that might just save us all. Today, we look past the mainstream media hype to uncover what is actually happening to your money. Welcome back to The True Analyst. Let's put these two conflicting realities side by side. In one corner, you have a gross GST collection of 1.94 lakh crore for June, registering a stellar 13.9% growth year on year. This is the headline that dominates the news cycles, signaling robust economic strength. But right next to it, you have the industrial data showing manufacturing momentum hitting a 4-year low, with business confidence taking a sudden massive hit in a single month. To understand why these two metrics are pulling the economy in completely opposite directions, we have to pull back the curtain on our very first pillar, the grand illusion hiding within those record tax numbers. Let's dissect that 1.94 lakh crore figure. On paper, it looks like an explosion of domestic consumer demand. But when you open up the actual ledger, the narrative completely flips. Look at the data. Real domestic GST revenue grew by a very conservative, modest 6.5%, coming in at 1.34 lakh crore. In a rapidly growing economy like India, a 6.5% growth rate indicates that domestic retail consumption on the ground isn't surging. It's stabilizing, even cooling down. So what carried the massive headline growth? This number right here, a spectacular 34.6% surge in import-led GST, which brought in over 60,038 crore at our ports. Think about the structural reality of this. We aren't seeing an organic boom in people buying more goods produced within India. The headline number is heavily inflated because we are aggressively importing components and foreign goods. The government collects its tax at the port entry, which looks phenomenal on a spreadsheet, but it masks a softer domestic consumer market. This flattening of domestic demand brings us directly to our second pillar, the factory floor. India's manufacturing PMI came in at 54.2 for June. Now, to be fair, any number above 50 means the industrial sector is still expanding, so we aren't talking about a recession. But momentum is a leading indicator, and right now, momentum is fading fast, hitting its second lowest reading in 4 years. The real area of concern isn't the headline index, it's where the slowdown is concentrated. The primary culprit dragging down growth is the capital goods sector. Capital goods are the heavy machinery, plants, and factory equipment that businesses buy to expand their production capacity. When this sector slows down, it means corporate India is actively hitting the pause button on expansion. They are looking at their order books, seeing domestic demand moderate, and holding off on capital expenditure. This is why the proportion of firms forecasting aggressive growth literally halved in a single month, dragging business optimism to a 5-month low. So we have a cooling domestic consumer market and a corporate sector pausing its expansions. In any typical market cycle, this combination would spark severe anxiety in the equity markets. But it hasn't. Why? Because of our third pillar, a massive economic wildcard working heavily in India's favor, the global crude oil market. Global Brent crude prices have quietly slid back down from their recent peaks, handing India an incredibly well-timed price cushion. Remember, India imports more than 80% of its total crude oil requirements. This makes the global price of oil the single biggest swing factor in our entire macroeconomic equation. When oil drops sharply, it triggers a powerful transmission mechanism across the entire corporate landscape, fundamentally altering our trade dynamics. Let's track exactly how this cheap oil works its way through the economic system. First, input costs fall drastically. Crucial margins for sectors like chemicals, paints, aviation, logistics, and automobiles are heavily protected, even if their top-line sales volumes are moderating due to slower domestic demand. Their bottom-line profits are insulated because raw materials are suddenly much cheaper. Second, our trade deficit shrinks significantly. When less capital flows out of the country to pay for expensive oil barrels, India's current account gets meaningful, much-needed breathing room. And finally, this narrower trade gap directly stabilizes the Indian rupee. After enduring a remarkably rough stretch of pressure through the month of May, the currency is finally finding its footing. Falling oil acts as an invisible shield, preventing a domestic slowdown from turning into a broader macroeconomic crisis. This brings us to the definitive true analyst verdict. Is the Indian economy in structural trouble? Absolutely not. What we are witnessing is a classic K-shaped consolidation phase, creating a sharp divergence between macro and micro data. On the macro side, things look exceptionally strong. Government cash reserves are highly secure. The trade deficit is shrinking on the back of cheap oil, and the rupee is successfully finding its stability. But on the micro side, the data is undeniably cooling. Ground-level domestic GST growth is sitting at a very muted 6.5%. Factory orders and private corporate capital expenditures are temporarily on pause, and overall business optimism has pulled back to a 5-month low. For investors and analysts, understanding this split is the absolute key to navigating the current market environment. So how do you trade or invest in an economy sending these mixed signals? You follow a defensive, margin-focused playbook. First, you must favor margin over raw momentum. The era of blindly chasing high-valuation growth stocks and expecting effortless double-digit returns is temporarily on pause. Instead, you want to lean toward cash-rich companies that benefit directly from lower input costs, rather than companies relying on aggressive, immediate expansion bets. Second, you need to track capex execution with extreme discipline. The government's massive 12.2 Lakh Crore union budget capex allocation is a phenomenal headline, but a headline doesn't move factory wheels. The critical signal to watch over the next few quarters is how fast that allocation actually converts into ground-level contracts and real-world dispersals. That contractual flow is the only thing that will restart the capital goods cycle and pull manufacturing momentum back up. At the end of the day, these mixed signals aren't a sign of a failing economic engine. It is simply an economy transitioning away from an explosive post-conflict surge and settling into a mature, stable, and sustainable growth path. But as always, the most valuable insights come from the ground. Are you starting to notice a visible business cooldown or an order slowdown in your respective industries, or do you believe the broader macro numbers are signaling a massive rally ahead? Drop your analysis and your take in the comments below. If you want to continue looking past the mainstream media noise and truly understand the core mechanics driving your investments, make sure to hit that subscribe button. We will see you in the next deep dive on The True Analyst.